Now, one of the easiest ways to determine whether a price trend is in an up or a down mode would be to plot the fast trend line and the slow trend line and monitor the crossing of these two trend lines. For example, an uptrend would occur if the 40-day trend line crossed above the 80-day trend line, and we would want to buy stocks in this example. And a closing price downtrend would occur if the 40-day trend line crossed below the 80-day trend line, and we'd want to sell stocks in this example. Now here's the daily price chart of Pfizer, and this blue line right here is the 40-day fast line. The red line is the 80-day trend line, and then we have the daily price bars for Pfizer stock. Now we can see that the 40-day trend line crossed below the 80-day trend line right here, indicating a sell for Pfizer stock. And once we get a sell signal like this, we don't want to buy the stock because we don't know how far the stock's going to go down or how long this price trend is going to continue down. So you don't want to buy once the 40-day trend line crosses below the 80-day trend line. And we don't want to buy a stock until the 40-day crosses above the 80-day. Now we can see here that the 40-day crossed above the 80-day, signaling it was okay to buy Pfizer stock again. So monitoring the 40-day and 80-day trend lines is an easy and effective way to determine the current trend of buying pressure versus selling pressure. And just to recap the MVP trendline stock strategy rules, we want to purchase a stock if its 40-day weighted trend line is above the 80-day weighted trend line. And we want to sell any stock if the price of the stock declines 15% or more from our entry price, or if the 40-day trend line crosses below the 80-day trend line, whichever occurs first. Now here's some recent examples of MVP trendline strategy trades. This is a daily price chart for Medco Health, and the 40-day trend line is this red trend line, and the 80-day is the green trend line. And we can see here that the 40-day crossed above right at about the $57 level, and the 40-day has stayed above the 80-day trend line, indicating that the price, or indicating that the stock is still in a buy mode. So as long as this 40-day trend line stays above the 80-day, the stock is a buy. And here's another example. This is for Monsanto. And in this chart, we can't actually see the crossing of the 40-day above the 80-day. That occurred prior to this one-year chart. Now the trendline strategy also acts as a safety switch, and it will tell you to exit a stock if it enters a downtrend, and it can save some pretty big losses if you follow this system, this simple system. For example, the trendline strategy issued a sell signal for Countrywide Financial at 37.20 right here, and Countrywide's currently trading at $4.96. So if you were following this strategy and you own Countrywide stock and you sold right here, once it entered a downtrend, it would have prevented a 87% loss based on current prices. Now page 11 and 12 of my MVP book contain additional money management rules that we use in addition to selling when the 40-day trend line crosses below the 80-day trend line. Here's another example of the safety switch sell signal. This was for Nortel Networks. The 40-day crossed below the 80-day at around the $60 level, and as you can see, it stayed in a downtrend and would have saved you from considerable losses following the strategy. And again, once that 40-day crosses below the 80-day, you don't want to buy the stock until the 40-day crosses back above the 80-day, because you don't know how long or how steep the decline is going to be in the price. Here's another example of a sell signal for Sun Microsystems. And it sold Sun Microsystems at around the $45 level. And you can see, again, that would have saved you from big losses. Now we're going to take a look at some historical results for the Trendline strategy. I used the Omega Supercharts program to perform this historical testing. And the Supercharts program allows me to do historical profit calculations using the Trendline stock strategy rules of purchasing a stock when its 40-day trend line crosses above the 80-day trend line, and selling a stock when its 40-day trend line crosses below the 80-day trend line. Now, what I have listed in this table are the historical profit results for a very broad cross-section of stocks in virtually every type of industry from July 1st of 1982, or when a stock first started trading, through July 1st of 2006, which is a 24-year test period. The average test period was about 14 years. Results are based on initially investing $200 in each stock for the first buy signal and compounding the results thereafter, and they don't include commissions. So this sampling includes both growth and value stocks. Now, these historical results reveal that the Trendline stock strategy produced impressive profits with very low risk. The total initial capital required to invest $200 in each of these 50 stocks was $10,000. Now, this $10,000 investment generated $341,000 of profit, which translates to a 3,400% return on the initial $10,000 investment. And over the 24-year test period, this return rate allows us to double our initial investment every year on average if you let the initial investment compound. Now, the average profit factor over the test period was 18.7. Now, that translates to more than $18 of profit for each $1 of loss. And the profit factor is calculated by dividing the total losses by the total profits. And it's a good measure of risk. A high profit factor indicates that the Trendline strategy has kept our losses to a minimum by exiting losing trades before they develop into big losers. And it maintains winning trades as long as the stock remains in a price uptrend. So the Trendline stock strategy almost always exits a trade before a big loss occurs, and it provides us with the discipline necessary to become successful investors.